Just so you know, the split here roughly is like 70% GPs or aspiring GPs, kind of like 20% passive investors, allocators, and then like the remaining people tend to be service providers of various type, lawyers and brokers and everything. And I want to, I'm saying that because I think that we GPs can get so into our own bullshit that we sometimes don't get that like reflected view back from the allocators, like about what we're doing right and what's crazy. So the next person I want to invite up is the kind of person who hopefully is going to cure that. He is one of the most original thinkers about real estate who I have come across. Whereas a lot of us can get spun around our own axles with mythology and with talking about IRR and terms and all kinds of other stuff that we maybe or may not understand. He's kind of a first principles thinker, which is right up my alley. So let me bring him up, Eliot Bencuya from Tryperion, and we're going to talk about deals and terms, and hopefully he's going to upset all of us.
Thanks for having me, Moses, but I'm not going to cure anybody of anything. The market is the market.
Here we go. All right, so let's get started by, I guess, just to give everyone a sense for your vantage point on the market. Maybe you could give us a brief kind of introduction to your business and how you're seeing the world right now.
Sure. So Tryperion we're a small, mid-sized fund. We're on our third fund. It's $60 million. We started in 2013 with a $50 million fund. And so we're generally allocators. The way that we view the world is we're typically allocators in the $3 to $15 million range. All asset classes, generally majority LP, but we look up and down the cap stack. We'll do mezz loans, we'll do preferred equity, and we will buy deals directly. We have bought deals directly, specifically office buildings, some shopping centers. But we have a pretty, not so much in the coastal markets, generally in the non-coastal markets. But we kind of have a wider lens. We kind of see everything.
And that's, I mean, again, as everyone knows by now, I'm so focused on apartments and LA, and I've got this tiny little aperture through which I view the world. And Eliot and his team are obviously looking across all different asset classes, geographies, up and down the capital stack, and so is in a position to kind of compare risk-adjusted returns and terms across different kinds of deals in a way that I'm not, and I think many of us aren't. So that's kind of what we're going to try to talk about today. First, I want to start by asking about that distinction between operator and allocator, though. You have the ability to buy deals direct, and you have done a lot of that. And then, of course, as we've been discussing, you have the ability to allocate to other people's deals. Let's talk first about how you make the decision between the two.
Yeah, so, I mean, because we are not an expert in any particular asset class, we kind of know our limitations. So, for example, when it comes to retail, we bought a shopping center directly. It was a pretty stabilized shopping center. We just had to sell some pads and do a handful of extensions and move on. And even on something, and we just bought it because it was cheap. It was in San Antonio. We were getting a lot of cash flow, and after you sold the pads, we were totally out of the deal and owned the rest of the shopping center for free. So it was like a financing game.
I just want to make sure everyone heard that. You bought this thing. There was so much cash flow coming in that you could, between the cash flow and selling the pads, that you guys could have all your equity back and then just have like a permanent cash machine.
Yeah, and lenders, and in particular CMBS lenders, are like terminal cash flow brain. So like you just carve out the pads from the CMBS loan, and you own those free and clear. So that's not their collateral. You sell that's your money, and now you just cash flow, and you either sell the building or you sell the building to the lender in 7 years and give it back to them. There's a lot of like weird anomalies in the market like that. And to be clear, like I am a real estate person, but I'm also like fundamentally a finance person. My background is in finance, so everybody gets sent investment package or an OM or whatever, and they see like, real estate, and I see real estate too, but I also see I just see, numbers.
Cash flows.
Yeah.
Yeah. Okay. So in addition to the shopping center you've done, you've also built up a pretty large portfolio of office buildings.
Correct. Yeah. So when we started in 2013, to be clear, when we started in 2013, we very much started on third base. I started Tryperion with my two partners. We were all colleagues together at our prior private equity firm. One of my partners, has access to capital through the family money. So, we started very much on third base. We've since expanded our investor base over the next couple funds. But it's not like we were 30-year-olds and they were like, wow, these guys are really good.
Here's $50 million to do whatever you want with.
Right, exactly. So, we started, we very much had a leg up. But but our thesis leaving this firm was, so I covered the Midwest for acquisitions at my old firm. And there were just a lot of deals in the Midwest at the time in 2013 that were trading at tremendously high cap rates, even for very good real estate, in particular office buildings that had a lot of contractual cash flow. But the debt was not differentiating pricing-wise between something in LA and something in St. Louis. So we were we were trying to get our old firm to like buy these. They were like, no way, I don't even know where St. Louis is. So we said, okay, then I guess we'll just go do it ourselves. So
let me jump in there because I want to just make sure that everyone is clear about what's going on. So let's talk about the real estate first, then we'll talk about the debt on those. So in terms of the real estate, you got these well-located office buildings. And when you say contractual revenue, rents, you're talking about credit tenants here.
Yeah, we're talking about like, Energizer's headquarters, Panera's headquarters. Very large established tenants with, 8 to 10 years of term left. And so you've got these office buildings with 8 to 10 years of term left trading at 9 caps, and the debt is L plus 215. And so you just buy it, and then you just have 16, 17% in place cash flow from the day that you buy it.
And what do you think was going? Obviously, when I hear things like and obviously these opportunities probably don't exist anymore, or
they do not. They didn't. Right. Yeah. Right,
So don't everyone get excited. But I do want to drill in like. Your old firm said no thank you when you tried to pitch these deals to them. Mm-hmm. Do you think that are the high cap rates just a reflection of basically all of these smart coastal real estate firms saying, forget it, we're not going to do that, so there was the opportunity? Like, why were these things available at those cap rates?
It was available at those cap rates at the time because that's not where the mandate-driven investment flows were flowing. And at the time, and it's just... Look, this whole thing is about flows. It's always about flows. Everything is about flows. And that's just not where it was flowing. And so we went there and, we came in there and we said, hey, we're these guys from LA. We've got a $50 million fund. And everybody's like, oh, awesome. Somebody
Thank
showed
God.
up. Yeah. It's like so great. Somebody showed up here. Wonderful. And, today you show up and they're like, I'm sorry, I have, 10 family offices with $100 million line of credit. Get in line. And so that's just, it's a little less interesting.
So that we talked about the availability of the assets themselves. Let's talk about the debt. To me, the equity markets were pricing in a lot of risk, either a lot of risk or else concern about lack of rent growth going forward. Like that's why there's a 9 cap there, right? But the debt was willing to be really cheap. Like why? Why was the debt available at that rate?
The debt was available because, from a bank's perspective, if something is like 60% leverage, they'll lend on it. They're not even, if it has cash flow and it hits certain metrics, they'll look at the real estate. But as long as it hits certain metrics, you'll generally find a lender who's going to do it, especially if you're not, trying to get 75, 80% leverage.
And so for you guys,
so that was we did a bunch of deals with Wells Fargo at L plus 215. But what's really funny about that is this is also very stupid. We went to the Wells Fargo in LA and they were like, sorry, you don't bank with us. We don't know who you are. So then we ended up with the Wells Fargo CMBS group in New York, and the Wells Fargo CMBS group, but we said we don't want a CMBS loan, we want a bridge loan. And the CMBS loan group in New York was like, oh, that's okay. We have like a little side pocket to do, bridge loans out of the CMBS group in New York. So then we got rejected by Wells Fargo LA, and then we ended up doing the deal with Wells Fargo's bridge loan, same balance sheet, different group, in a side pocket. It's incredibly stupid.
And was it just, now this is, I want to pull that thread a little bit. Was there a loan broker working on your behalf, or how did you? Yeah. Okay. Yeah. So someone good, just running down all the different options.
Yeah, for sure.
And they earned their money there. It sounds like
they did for sure.
Yeah. Okay. All right. So, I guess my next question is, you've never owned an office building in St. Louis before. So how do you go about like figuring out how to manage that? And
yeah, so between my three partners, one of us is essentially investor relations. I was mostly acquisitions, and our third partner came from the asset management side. So we kind of had all three departments when we started, and we really let him run with it. He's a phenomenal operator of pretty much all asset classes. It's actually very impressive, and we spent a lot of time in St. Louis that year, meeting with property managers, leasing brokers, whatever. And the nice part is it's not a big city, so you spend a few weeks there, and you spend a few weeks there, and you're the only person coming in to buy stuff. Like, you're everybody's best friend.
So immediately you close on the first one. Immediately people start handing you more opportunities.
Yeah, and then when we went to buy the second one, they knew that we had just closed on that first one, and we already had an established team, and so now you start to get scale on the property management side. Your property manager scales between them, your vendors scale, and so that's kind of how it started.
So how large I don't know if you've started to sell these at all, but how large a portfolio did you guys build?
No, it's embarrassing how small our portfolio is at this point, considering how much that we've sold over the last year. So I think, or the last few years. So, I mean, I think at our peak, I don't remember the numbers exactly, but we probably owned, 18 to 20 properties across all asset classes, and Minneapolis, Indianapolis, St. Louis, San Antonio, Phoenix, et cetera. And I think, we have 5 properties left. We've been selling stuff very heavily over the last few years, and redeploying into, we could talk about it, but more structured finance stuff.
Yeah, actually, I think that actually is a great segue to talking about what you're doing now. So, and this flexibility that you have to start out being an operator, because that is what made sense, to then sell because presumably you feel like valuations are toppy.
Yeah, so look, here's how it went. So we started buying these office buildings in St. Louis, and we were buying them directly, and they were great. But that opportunity dried up pretty quickly in 2013, 14. The cap rate started to compress very quickly. And so then we started to do more value add deals. When we did the value add deals, we became, at the beginning, let's say half of the stuff that we bought was direct acquisitions, and half was majority LP with local operators and joint ventures. Over time, that switched to, where 80% of the stuff that we were doing, we were the majority equity partner as the LP in a joint venture with an operator who was actually good at, operating and adding value, as opposed to us. We were just playing, at that point, kind of just we did leasing, but I mean, it was really just a market bet. But yeah, as those cap rates compressed and we had to actually properly add value, then we worked with local operators to buy hospitality, to buy retail with somebody who could actually lease it, that has the relationships in retail. And that's where we learned that we can't operate a hotel. In the retail space, you really have to have relationships with retailers. You can't just it's not like an office building where you just hire an office broker. I mean, it is kind of, but it's a lot less. Like, the relationships in retail matter a lot more than a relationship with somebody using Office Desk.
So I want to ask, and this is, maybe we're just getting back to my personal psychoses here, but like, terrifying. You're gonna pick out some local operator who has a track record, but presumably you don't know them before you start looking at deal. Now, do they come to you bringing a deal, looking to get it capitalized? How are you meeting these people, I guess?
We're going to the markets. You're meeting with brokers. You're meeting with a lot of operators, and you turn over a lot of rocks with a lot of operators, and you usually don't do the first few deals that you see with somebody. See how somebody thinks, see how they operate, and then eventually you buy it. But the one thing that was always really comforting to us going to these markets and working with operators that we hadn't never worked with is that we are fundamentally, like, I have a tick or something like that like, if it doesn't cash flow, like, I have a problem with it. And so we were always, we were working with operators that we didn't know, but we were buying industrial properties in Minneapolis at an 8.5 cap. And like, if nothing happened, then you get a 13 and it's, cheap to operate. So, that's okay.
And so I'm imagining
that also doesn't exist anymore.
Don't everyone get excited there. I'm imagining, it's one thing to do deals with people you've done a lot of them with, right? It makes the negotiating the agreements easy, and there's a lot of trust and everything. With these one-off type relationships, I imagine that process of negotiating terms and documenting them is potentially more fraud. Can we talk about like how, the nuts and bolts of actually organizing? Are these guys coming to you with like a proposed LOI? Here's the deal. Here are the terms I want. Or are you getting involved earlier to kind of structure the terms with them?
Yeah, we're generally getting involved earlier, and then, typically it works. We put terms in front of them. They say, that's not enough fees, that's not enough promote, and then, you fight over it a little bit. And then you try to just do the deals with the people that, like, yeah, even though you're fighting over it, you can see through that they're actually, like, a good person, because you could put whatever you want in a document, unless you're, doing a deal with somebody who, at heart, you, like, have a gut feeling is a good person. You can't structure around that.
Right.
And so, yeah, the back and forth is, it all becomes kind of typical what the back and forth is. But as long as there's a good person sitting on the other end of that, table, then you do it. If you get the heebie-jeebies about whether or not that person's a good person, then you could just kind of drop it regardless.
And is the heebie-jeebies you're talking about? I imagine the answer to this is going to be both, but I guess I could imagine a couple of different things. One is just interpersonal stuff, like someone's just kind of like rubbing you the wrong way. The other possibility would be someone negotiating in a particular manner. In other words, emphasizing certain terms over others. Which are both of those things are important to you, or does one of them or the other give you more pause?
I think it's not even those things. It's like, are they thoughtful about the way that they are diligencing the property or thinking about it? Or are they just like, are they just like, oh, here's the broker package. What do you think? Should we do this deal? And I was like, I don't know. Should we do this deal? What do you think? You could tell who's like remarketing the deal, and who has actually thought about the ways in which they can perform.
So it's
a matter of like thoughtfulness. It's like, are they thoughtful? Are they, are they just walking away from the table from you when you put something in front of them? Or are they like, okay, let's work together. Here's a very detailed business plan. I've really thought about it.
That makes sense to me. In terms of documenting itself, like, are you imposing on them your deal docs? Like, is it your attorneys and you put the docs in front of them, or is it more?
Yes.
Collaborative? Yeah. Okay. And you have, I imagine, since you're putting your...
But we're controlling investor. I mean, we're like 90% of the capital. We're not.
So that's what I was going to ask. So, okay. So you're going to, so you're going to get a bunch of control provisions, right?
Yeah, we're going to get a bunch of control. We're going to get all the control provisions other than things that might expose them to personal bankruptcy recourse. Yeah.
Got it. Okay. So this is obviously old hat to you because you've negotiated a lot of these things before, but I think a lot of people in the audience, if they've raised investor capital, have probably done so via syndications where it's like a bunch of small checks and no one really, they're in the driver's seat, and the investors are either taking the terms or not. But we've done a bunch of these joint ventures where we're working with one capital partner who's putting up all the money. So I've been on sort of the other side of the table from the one that you're describing right now. Talk to me about specifically what those control, like what are you actually asking for?
We are asking for everything that isn't bankruptcy.
So you can fire them.
On a day-to-day basis, we're letting them run with it. We're not running the property day-to-day basis. So there is some framework for, day-to-day decisions that goes into, Exhibit A or whatever that allows them to run the property on a day-to-day basis. But as decisions, if there's a financing or a sale or a big lease, or some major, additional capex or something that hits certain thresholds, then, then we have decision rights, and we're fairly involved on the capital. We're not a purely passive allocator, and there are purely passive allocators, and they're probably wonderful. We are not we're not there with you every single day, but we're on the phone every couple of weeks, and we're fairly involved.
Does it look like sort of regular calls between your asset management?
Yeah,
guy?
every couple of weeks. We're 2 weeks, 4 weeks, whatever.
And you're looking
we're pretty
at budgets.
involved.
Okay. I think I asked that again because I think
we're a hybrid, right? Because we operate. We're also capable of, staying close enough to
and not afraid to take over the deal if you absolutely had to.
Yeah, we won't do a deal that we're afraid of taking over, which is why we haven't done development or why we haven't gotten to very hairy deals, is because if there's a deal that we can't take over and confidently manage, then we're probably not going to do the deal.
Okay, so we talked about this process for sort of like going and establishing a network of operators. We talked about negotiating the terms with them. As time has gone on and cap rates have compressed, you've sort of moved in that direction, away from doing direct deals towards this quote unquote passively allocating. I want to talk more now about the kind of stuff you're seeing, both the deals themselves, so asset class, market, and projected performance of those deals, and also about the terms that you are being offered by the operators themselves, or that you're discussing with the operators themselves. So let's talk first about what kind of stuff are you interested in and seeing right now?
Okay, so the way that I generally view the world is that if you're trying to invest in real estate, right? If you just take it very, very basic, there's a few ways to buy real estate. One, you can buy public REITs. You can buy for $10, and you get access to a gigantic portfolio of real estate. And that real estate is there. It's not like you're buying paper. I mean, they own real estate, right? That's the easiest way to do it. Over time, people have found more investment in private alternatives and private real estate, and the flows to private real estate have been astronomical, to the point where the reason that people were doing private real estate in the first place is because public real estate, public REITs were much more expensive, and there were real opportunities in private real estate to generate returns above market, right? There's a fundamental level of market returns for real estate. Yes, there's geographic overlays and there's product type overlays or whatever, but there is a baseline that the market is going to return. And so if you're going to pay somebody fees and a waterfall, when somebody sends me a 15% IRR or whatever, here's the deal. Well, you look at it, it's a 15 IRR. I don't see a 15 IRR as you're doing a 15 IRR. There's some component of that 15 IRR that is the market doing the heavy lifting for you. And then there's some component of that IRR that is ostensibly what the operator is supposed to add value and create above what the market is giving them. And then that operator says, okay, but I want to take this much in waterfall, which kind of takes you and promote and fees, which takes me as the allocator back down towards market. And so there's basically a whole dial of promote and profit sharing that is okay, if there is absolutely no waterfall whatsoever, then I capture 100% of the value add above what the market has given. Once you start to turn that dial and turn that knob, you're now bringing me back closer and closer and closer to what I would get in the market if I just sprayed and prayed into whatever.
And you by buying REITs or whatever, and you'd get liquidity, and you'd get audits
exactly.
and all that kind of stuff.
And so, like I said, I come from a finance background, right? So I when somebody says, okay, I want 60 over a 6 or 60 over an 8 or whatever, we also have the ability, and we're looking at a lot of this right now, is preferred equity and mezz. And those and that's basically it's capped upside. It's just you're basically just lending subordinate financing. But you have real equity subordination beneath you. So for example, if somebody says, we did a deal last year where we were preferred equity behind an agency loan on an apartment deal where the agency was providing 70 something and they really wanted more leverage, 85%. So we said, okay, we'll do that 15%. And they're putting in 15% subordinate. And we're charging whatever it is, 13, 14. That also doesn't exist anymore.
I want to, before we move on past that, I just want to, because some of the people in the audience are obviously have done a million of these deals and they're very sophisticated. There are plenty of other people who are probably hearing what you're saying right now and eyes glazing over. And so I want to just tease out I want to go into a little bit more detail about how that is being structured, why you're getting the return you're getting, and why you're comfortable allowing someone to go to 85% leverage. So walk us through that. So there's a senior loan at 70% or something like that?
Yeah. So, okay. So for example, in that one,
so this is someone, sorry, apologies for interrupting you. Someone's buying an apartment building. Is this going to be a value add thing? They're going to fix it up and flip it?
Yeah. But in this particular case, and what we really like about it, and we won't do preferred equity behind a bridge loan, going up that high, because the whole point is that we're trying to not take the interest rate risk. So in that one, it's a 10-year agency loan, but our preferred equity is a 3 to 5 year preferred equity. So even in the event that we're not paid off by 5 years, we still have 5 years of agency at 3%.
In other words, if you have to take over the building.
If we take over the building in 5 years, we still have 5 years of runway behind the senior loan. So we're not exposed to any sort of maturity risk at the point that we take over. And I would be happy to own that property at a 15% discount to today's market.
With term left on the
with term
agency
left on the
okay.
senior loan for 5
so
more years.
you're coming in and you're providing.
So somebody says, okay, I'll pay you 13, and that's all you're going to get. I'm very happy with that. If they pay me off, fantastic. If they don't pay me off, now I own a property at a 15% discount to their basis.
And they're willing to do that because it juices in their mind. It's juicing the return to the equity, which is going to take the losses before you guys do.
Correct. Yes. And I think this opportunity exists because there's a lot of risk taking in the market right now. So people are much happier to take higher leverage today than they were a few years ago, which is a very funny market quirk that as the market gets more expensive, people are also willing to take more additional leverage. And so, that's why, our history has always been, joint venture value add or direct value add. But as the market has shifted, we've kind of, instead of looking for different asset classes or whatever, because the distress doesn't exist outside, maybe hospitality or whatever, not really there either. We decided that, you just have to adapt, right? You just have to adapt with the market, and everybody adapts in a different way. Some people go to different asset classes, some people buy core, whatever. You just have to adapt. And our adaptation was doing more of this subordinate financing stuff, where if we can still earn, albeit a capped interest, a capped 12, 13, 14% return, we're happy to take that trade-off of the additional upside for the 15 to 20% common equity subordination, and we're again happy to own it. I don't want to own it. I want to tell all my borrowers I don't want to own it.
Let me ask, you're not Apollo then?
No, we're also not really lenders. I don't even like lending.
Yeah, no,
I hate lending.
I was going to ask you. So,
I don't even want to lend. I want to buy shit. This is really annoying to me that I have to lend. I don't even want to do it.
And I guess point of clarification. So this, you're calling it pref equity. Is it from a tax perspective? Is it interest or is it
interest?
So you're not getting like a depreciation shield or anything like that.
You can negotiate some, but yeah, it's interest.
In general, it's basically
like no, it's not terribly tax efficient. It sucks. Look, I'm telling you, I don't even want to do it. Okay, I'm just doing it because that's like what the market is giving me. So I will just take what the market gives me. But I would rather buy stuff. We did buy an office building. It was our first acquisition in a long time, a few months ago, back to St. Louis after we sold a bunch of stuff in St. Louis. So we had a big portfolio in St. Louis. We sold most of it. And then a few months ago, we bought another office building in St. Louis, and I was very happy to buy something, especially in a market that we knew particularly well. And it's a really trophy asset. It's a top 5 building for St. Louis. I'm much happier, but that was also that's just not. It's not thematic. It's not scalable. It was like a one-off deal that came out to market last year, and then something happened, so they pulled it from market. So then it came back to market, and we weren't going to win the first time, but then we did get to win the second time. But it's not repeatable.
I want to switch now to talking about how you're capitalized, because when we talked previously, you've raised 3 of these discretionary funds, and like when I get discretion, it's you can buy apartment buildings with 5 units or more in Los Angeles County that have a big value add component. The kind of discretionary that you've been getting for your 3 existing funds is much broader than that. You guys can do anything.
Yeah, I think except casinos.
Which is like a lot of people out here are thinking that that's like a dream. And yet, in our conversation previously, you were talking about moving more towards a deal-by-deal model.
Yeah, so the market has changed not just in the types of deals that you can do, but also in the way that capital can be raised. So like I was saying, Keith said the grass is always greener, and I think that's true. We've been doing these little funds for the last 8 years, but having a $60 million fund or whatever meant something 5 years ago, 6 years ago. It doesn't mean anything today. So why?
You're not getting the benefit of having.
Yeah, you're not really getting the benefit of it as long as you have, as long as you think you have investors who will close deals on a deal by deal basis. And I think this is the direction that we're going to go. Is the deal by deal route. Because the market, there is no benefit for a small fund. So like, you either have a gigantic fund where you don't really care about the returns. You're like, I'm going to do $200 million multifamily, $200 million industrial, $200 million life science, and I'm going to go raise another fund.
And that's an asset management fee play. You're just stacking,
an asset management
recurring.
Fee. So like our options are, you could become a gigantic fund, which to be quite honest, I'm a very bad, sale. I can't sit in front of a pension fund and be like, I'm going to get you alpha. I'm going to do it. I promise. Like sitting in front of some like Korean, some like Korean insurance. This is it.
We are the ones who see the off-market deals, not the other 12 guys doing the exact same thing.
So like I'm just like terrible at that. And so if we're just if we're so focused on returns, then it's just going to be better for us to go deal by deal than it is to like
talk about the downsides, because we've experienced this too. Talk about the downside of running a fund. So you're not getting the upside is
okay.
Of course,
here's the downside of running a fund. We were in contract to sell the last property in 2 of our funds, and we've been waiting 8 years for promote to crystallize, and the buyer fell out of contract. He didn't fall out of contract. He handed us a deposit the day of closing. So now we still own these 2 properties. It's been 7 years, and like we're still waiting. We've sold like 15 properties, and we're like still waiting for that last check.
And all your promote is effectively in this last.
Yeah,
one.
it's all in there.
Like you guys basically own this last building. Effectively.
Yeah, exactly. So like we're that's the downside of it is the cross promote.
Yeah.
And if you have $1 billion fund, it doesn't matter.
You don't care because you don't care about the
who cares
returns.
about the promote.
Yeah.
But if you do care, then you care.
Right. Okay. So this is a switch though for you because the funds. Talk to me like minimum check size. Like what are we talking about? The check size of the funds. Like are these are
it
7
ranges
figure?
$500,000 to $5 million, I guess.
Okay. So. And deal by deal is potentially somewhat of a different audience, right?
Yeah, totally. I'm terrified of going deal by deal, even though we have 10 years. Because I
just got to talk to Keith.
I'll talk to Keith after. Because I don't know how it's gonna go. Because we've never done it, right? We've had distinct fundraising cycles that are several years apart. And then we haven't had to think about it for a while. And so on a deal by deal basis, I really don't know how it's going to go. So part of me is excited to start from scratch like that. I think it's going to be a new challenge. Part of me has no idea what's going to happen.
I'll tell you, we did it from, so we historically had done joint ventures, one-off and programmatic with very wealthy families that wrote the whole check for a deal or a series of deals. And then we've also raised these tiny discretionary funds, even smaller than yours, and did our first kind of classic syndication 6 months ago or so. And you know what? We sucked at it. Like we raised the money, and we just have done a subsequent one. We raised the money on that, but it's amazing how different the fundraising process is when you're under time pressure to actually go close on a deal. So have you thought about the actual like the mechanics of how you're going to build the investor list, how you're going to manage the investor relations process?
I have not.
Again, talk to Keith.
We're gonna stumble through.
You're gonna stumble through,
close our eyes
and presumably you go back to those.
Look, we still have like relationships. I mean, it's not like all of a sudden those relationships disappear, and we're certainly not going to commit to a deal without knowing that a handful of people are going to be there. Even though the most likely route is that we'll find a few people who will commit to it, and then we'll backfill, to commit to closing, and then we will syndicate after closing and backfill them and repatriate some of their equity is my guess.
And your idea is that will in your head when you're thinking about this new model, you're thinking about a series of deals of what size, or do you not know? Is it like purely
I think it's going to be the same thing that we've been doing. I think it's just going to be exactly the same thing that we've been doing, except that the difference is that we've never been able to buy a deal that we thought we could own forever, and we've never been able to do a deal that was like a 2-year flip instead of a 3 to 7 year hold
because
it has to fit a very specific box. So now that box gets to open up a little bit wider, and so if we see a deal that we're like, this is not a home run, but it's a good deal to hold forever, that we can go raise money for it. If there's a deal that's that we had to turn away because it was a 2-year flip, then we can do that. But realistically, it's still going to be a lot of the same kind of stuff that we're looking at now, and just kind of moving with where the market moves. I mean, that's just kind of our thing is just moving as the market is like these waves in the ocean, and you just kind of have to. You don't like sometimes where the waves push you.
But if you're an entrepreneurial firm, you have to.
But like you can either go with the wave, or you can like crash into rocks or something. I don't know.
So I guess I wanna close our conversation by talking to you about where you see those waves going. So like obviously right now you're seeing a lot of deals from a lot of different people all over the country, different asset classes. We all know that multifamily, industrial, in this crowd, self-storage, are really hot right now. And obviously there are other asset classes that are less hot, although everything feels pretty inflated. Do you have a view on where the wave's going, like where opportunity is and where you'd like to follow it?
I don't really. I'm very bad at that. Because if I was good at that, then I wouldn't have gone. I would have just bought a bunch of Los Angeles apartments in 2013 instead of flying to St. Louis. So I'm obviously really terrible at that. But there's nothing that suggests to me that anything that is currently happening is going to stop anytime soon and is likely going to just continue on the way that it is. So I don't see any reason that the current waves aren't just going to continue to get larger.
And when you're looking, so presumably you are also though being pitched deals in out of favor asset classes. Are people bringing you retail deals and hotel deals, and you're just saying, look, there's just not enough meat on the bone here, or are you just not seeing those deals at all? The problem with, retail or hospitality or office, let's just say though there's a kind of, less favorable asset classes, is that within those asset classes, you still have very good assets and very good locations. You have very good hotels, you have very good office properties, and you have very good retail buildings, right? And the really good properties, those aren't out of favor. They're not in distress.
Yeah, they're not out of favor. And then you have the less good ones within those, and those are trash. So that's a problem. Because those aren't just like one gigantic asset class anymore. There's good parts of those asset classes, and then there's this stuff that is garbage. So it's the stuff that is actually worth owning is not under distress. So the difficulty, which is what we wake up every day trying to do, is like trying to find the properties that are actually good within those asset classes that are getting, for whatever reason, lumped, with the worst stuff, and then to pick those out. But that's not like a hugely scalable model. You just you do a deal every, a few deals a year like that, but you're not going to deploy hundreds of millions of dollars into something like that.
I think I want to leave it there. Thank you very much.
Thanks for having me.